Happy Monday. Good evening, everybody. Let's go. I welcome you to our conversation tonight. For those of you who have been here for a little while, chiming in from YouTube, those of you who are chiming in from Instagram, welcome to our session tonight, where you and I get to have a conversation about how to achieve freedom, wealth, and legacy, man, through all the things that we get to do as an entrepreneur inside the business. I'm always excited to have this conversation with each and every one of you. And, today's an exciting conversation, something inside of the basics, the fundamentals of like what you and I get to do as entrepreneurs. It can be confusing. Let me get this music, guys. It can be confusing, some of the things that we do as entrepreneurs when it comes to business structures, entities, asset protection, taxes, really just making sure that you have more cash in the bank and that it's growing in a way that serves you and that you get to do everything that you envisioned when you became an entrepreneur, specifically if you're in the trucking or the construction world. What do we actually do to achieve that 100% clarity in what you and I get to do? So, a lot of it has to deal with like how we get set up from the beginning and how we maintain that setup and how we build on that setup from the beginning. And we had a conversation last week and the week before about some entities. We're going to talk more about entities and structures today. I'm excited to be with you. All right. So welcome. If you guys are here in the chat, I want to hear from you. If you wherever you're chiming in from, if you're from YouTube, if you're from Instagram, if you're watching me now live, and just make sure you're inside of this conversation. And we're going to have some real good conversation today and some clarity today about, what you can do when it comes to certain structures. We're going to talk about partnerships today. Okay, partnerships is what we're going to focus on. But look, if you have questions about how you're currently set up and if a partnership would work better for you than what your current setup is, or if you are currently set up as a partnership and what you've been up to inside of that partnership, and like even if you're a single member LLC, and all that goodness that's going on. Hello, welcome, Atlanta in the house. Let's go. All right, so welcome to the call. So this is going to be a real good insight. This is going to be real good insight for you and I and whoever else is in the conversation later on. So let's get started with this. This is about what the best business structure is for your business. Some people don't know, man. I've seen a lot. We talked about C Corps a couple of weeks ago. We talked about S Corps last week. And today we're going to talk about partnerships. But what's the best thing for you? How do you know? And what do you do with it? How do you leverage it to make sure you're winning inside of business? We get into all of that today. But let's go. First things first, let's get started with the intros. Let's go. All right. So from confusion to clarity. I love that. And that's the topic tonight. It's really going to be the topic that we want to cover. And Baxter, my man, good to see you, man, on the call. Well, welcome. Good to have you. And and this is a conversation that we're going to continue to have until we finish out the series to make sure you understand all these entities and how to use them. So what's the best structure for your business? We're going to find that out today. Okay. And then how to actually use that from a day-to-day perspective. We're going to continue that and reinforce that as we finish off this conversation, this topic about structures and entities, which is a building block of how you get to operate as a business owner. Okay, so this is pretty exciting stuff is what I want to say. But before we get started, guess who this is? Yes, this is me, Cheston Bulgin, founder of a company called By the Books Consulting, CFO and tax strategist here. Your accounting superhero. And you can reach us at 888-4BTB now. That's 888-428-2669. You can also reach us on the web at youraccountingsuperhero.com. That's youraccountingsuperhero.com. You can reach me at cbulgin at youraccountingsuperhero.com. And definitely, if you're on social media, you want to follow me on Instagram for conversations like this, small tips like this. We do some shorts and everything. Sometimes we just give you like a little bit of a tidbit. You may be thinking about what to do, and you might have an opportunity to check in on our Instagram and see what you can do if you're thinking about doing something in your business. Pretty good action to take is to follow us on Instagram at Your Accounting Superhero. And of course, we do accounting, tax, and we do business systems like QuickBooks Online to help you navigate technologically how to run your business and have that clarity that you're seeking. Not just that technology, but other technologies to help streamline. You would do like a lot of CFO work for businesses to ensure that there is clear action that's going to deliver, improve profitability, improve cash flow, and of course, freedom, wealth, and legacy. So, and that's a part of that business advisory package as well. All right. So that's what we do, man. That's who we are. So, quick disclaimer before we get started in this conversation: the following is for educational purposes only and is not to be considered financial, accounting, or legal advice. Please consult your tax, accounting, and/or legal professional for specific advice. And today we're going to be talking about partnerships. Look at that guy. That's me, old school picture, right? Tax and compliance. We're going to be talking about partnerships, and there's a 1065 there. We're going to talk about what that means, tax and compliance, but more so we're going to get into the structure of this. Is the conversation that we want to have. All right, so guys, just give me a heads up, man. What kind of structure do you already have? If you're watching this video with me today, just put in the chat. What kind of structure do you have with your business? Even if you're not with us today and you're chiming in later on, definitely put here in the comments what kind of structure your business has. What are you operating with, and why? Why did you choose that? And sometimes we don't really understand why we choose the structures that we choose. We just do it because this is what other people say, which is a common thing. And other times we're pretty clear on what we've chosen and why we've chosen this specific thing. I had a great conversation with one of our people on our community last week, and man, sharp dude, man, sharp guy. Pretty clear on what he was choosing. Awesome. Yeah, man. A lot of people in the house with LLCs. If you have an LLC, yes. Shout out to the LLC people. Shout out to the LLC people in the room. And, LLCs are very great. And we're going to talk about that too a little bit tonight in terms of what that means. But, some people, like I met with a sharp guy last week, and I mean, he's clear on the structure, just like you, trucking company. Some of you may have construction companies, but this guy had a trucking company. He was like, okay, I've just been educating myself on what to do, and I've been chiseling things out to understand like what I need to do to have my business perform and work the way that I want it to work and perform. So really great that he was able to do that over the time. And that's what I would want for everybody, because when you're like that, if you're here, then most likely you have that in you, because it's going to take being in the mode of learning and educating ourselves to understand exactly what it is that we get to do individually for ourselves. But when you do that, the thing that happens is that you get in a conversation with somebody like me, and it's high level. We actually go to work on, okay, what are you going to do? Like specifically, to move things forward. And it's not a whole lot of wasted time in the matter. You get to have really directed, powerful, and time-saving conversations that are going to deliver a whole lot when it comes to your outcomes in your business. You don't have to waste time. You don't have to waste all your energy. You know exactly what you're doing. And that goes a long way. Okay. So yeah, I got it. Sole proprietor, sole prop. My sole props in the house. Good stuff. Okay. And we're going to talk about sole props at some point in distinct terms. You're going to get a little bit more of an idea of what we call liability when it comes to running your business, rather, today. And guys, what I want to leave you with right now inside of this section of the call is, don't just go out here and do things just because you kind of heard it, and you kind of, even you're hearing stuff from me. I don't want you to just go out here and do things because you're hearing stuff from me. I want you to have this proven. I want you to have a proof of concept. I want you to know that this is actually going to work for you before you go ahead and jump in and make these types of decisions, because these are the ones that can actually have you go like with speed and confidence and clarity and conviction without having anything looming over your head when it comes to legalities and compliance. And also when it comes to asset protection, when it comes to taxes and tax savings, when it comes to building upon that structure later on, when you have new ideas to build upon your business. Well, how do you set that structure up? How do you segment that? How do you create new businesses from that perspective? So I want you to be in the know about, okay, these are the options I have available. This is what I understand about it so far. Now, let me take this conversation to my professional. Let me take this conversation to my professional so that we can have a high level conversation about what to do from here. Okay. Now, if you do it that way, guys, I guarantee you, you're going to increase your probability of successful outcomes in what you're doing in business exponentially. Okay. Just from you being in a conversation like this and treating it that way so you can have a high level conversation with the people on your team. Okay. Of course, if you don't have anybody on your team, just have those high level conversations with. Shameless plug. You can come over to Buy the Books Consulting with this guy over here, and we'll get you squared away. I'll have your back. That's my promise to you. I'll have your back. Okay. If you don't have somebody on your team that or even if you do have somebody on your team, but you're looking to have somebody, like you don't feel like a strong team member. Like I played on some sports teams back in the day, bro, and I was like, if I only had a different team, some members of that team that were like, have better skill sets and they were more accountable and they wouldn't drop the ball, I'd be better off, I wouldn't have to have everything put on my shoulders here. All right. So sometimes you want to make sure that you align the team with some strong members too. So if you feel as though you don't have strong people in that area, definitely come over and have a conversation with me or a member of our team over here. All right. Shameless plug. Shameless. All right. But guys, okay. So let's talk about this tonight. Let's get into it. The thing that we want to get into is understanding what partnerships are for your business. And I put something there called 1065 partnerships, but let's understand what the basics are behind this. All right. So let's go. Let's talk about some tax and compliance basics. I'm going to bring this up here, guys. So this is what you need to know. Something like I want to go over some fundamentals here. So there are two things, tax treatment, and there are asset protection basics. He said that cage, right? And he saw a picture of me out like an old school man back in the cage. I was in that fighting cage. Let's see that. I see you guys are commenting on that. Yeah, for those of you, just let me be with you really quick. Quick facts. Yes. I fought in a cage. Quick fact. I'm not going to say any more about that. All right. Now, some basics about entities and structures for your business when it comes to partnerships. Okay. We want to look at two things. There's going to be, of course, tax treatment, big deal. And it's going to be asset protection, huge deal. Okay. When it comes to these structures. So what do we have when it comes to a partnership? And what is a partnership anyway? Some people don't even really get, well, how is it that I get treated as a partnership? Why am I a partnership? Some people do go out here and form partnerships intentionally. Others get kind of thrown in it from one perspective, but not really understanding that they got thrown into it from that one perspective. When I say that, like LLCs, those of you who just go out here and create LLCs and there are more than one of you in that LLC. Guess what? By default, your tax treatment will be that of a partnership. Now, you may or may not know that, but when you sign up and register that EIN number for an LLC with the IRS, okay, and even with your state that has a little bit of a different understanding about it, like the different aspects to it when you register with the state versus when you register with the IRS. Okay, so when you get that EIN for that LLC, you'll get this letter. A lot of times it's almost instantaneously. You get this letter from the IRS website. It's an EIN letter. We call it a CP 575 notice. And it will go over what your EIN is, your tax identification number is for that business. But then there'll be a whole lot of information on that one page about what they expect to see from you when it comes to filing taxes. Okay. So you want to understand those forms. You want to understand the tax treatment. You figure you went out and filed an LLC, and they said that, and on that EIN letter will say, hey, look, when it comes time to file, we want to see a form 1065 from this LLC because you indicated that there's more than one member on this LLC, and by default, we're going to treat you as a partnership. That's basically what that means, and you want to understand what that is for yourself. And so sometimes we get wrapped up into it tax-wise unintentionally because we went out and created an LLC, and there are multiple members in that LLC. and this is how they're going to treat you when it comes to taxes. And sometimes you just don't even realize. Okay, so I want you to go in with your eyes wide open in these situations to know, the two different components of how this structure works. Because if you're going into in eyes wide open to form a partnership, there's a tax perspective and there's an asset protection perspective from this. Either you're going to have the protection or you're not going to have the protection, but how do you know? And if you're in business and you're working with the general public and you're going out here and conducting that business with others, which is what we do as business owners, well, then you're going to want to have a level of understanding about asset protection when you go out and form these business structures like partnerships. So that's a big deal as well, like asset protection. Of course, the first thing is tax treatment. So what do we need to know when it comes to tax treatment? Right here, we are looking at the tax forms. This is one of the things you want to understand. Well, pass through treatment of the business. What is that? What is pass through treatment of the business? And like quarterly estimated taxes. What's going on with that? You want to be in the know about what that is. And you also want to understand the deductions and credits and that are available in the type of business that you have, what goes along with that business, right? The ordinary and necessary expenditures that you'll have in that business to reduce your taxable income from the business activity. Okay. And then of course, things like payroll tax. Like, and what does it look like if you have a partnership? Do you give yourself a payroll? Does it make sense to do that? And, or does it make sense not to put yourself on payroll? And all of that wants to be clear for you when you're deciding on using this structure for your business. Okay. And, if you're in trucking, of course, 2290, how does that play a role inside of this business? How does that play a role in business when it comes to taxes? Okay. And, when it comes to asset protection, which is not on this slide here, it's like, well, how do we protect ourselves when we're operating inside of the business? Am I protected? Is insurance enough? What type of insurance do I want to get? And will that cover me in the event that something happens with my business? Or what if the insurance company doesn't want to pay? Well, what's at risk for me? How much is my risk exposure? How much is the risk exposure to my partner inside of this business? These are the things that we want to know. These are the things we want to actually go into this arrangement with our eyes wide open so that there are no surprises. We're actually doing things intentionally and we're getting outcomes that we are intentionally looking to get for our business without being blindsided by things that you just did not expect. Okay. Super important, guys, to know this. And, hopefully, like even in this section of the conversation, what I'm looking to do is make sure that I'm injecting something in your brain where you're conscious about this whole process. And really, it doesn't have to be something where it's stressful, where it's confusing. You want to keep this as simple as possible. All right, keep it as simple as possible so that you understand exactly what you're doing inside of your business. Okay, and it could just be getting on a quick conversation with somebody that has experience working with all these different structures and entities that can steer you in the right direction. And that way you can definitely have your eyes wide open on where you're choosing how to run your business with this in mind. Okay. Fantastic. So let's talk about the difference between the forms that will get filed here. Okay. And I want to just really bring this up for us here. Okay, so we're talking about income tax. I want to focus on income tax more so in this conversation with us. And if we don't have the time to get into the asset protection side of it tonight, that's okay. That's fine. We can continue that conversation next week and we talk about the asset protection side, about partnerships. Okay, and specifically, I talked about something called like when you file the LLC and how it automatically gets treated as a partnership when it comes to taxes. But then, well, how does it work with LLCs and asset protection? How does it work when I don't have an LLC, but I'm just going together with another person, another business, or some other relationship to form a partnership? What does that look like when it comes to asset protection and limiting liability in that way as well? Okay. All right. So, I'm going down the line because there are different entities, okay, that we we have. And we're looking at income tax. So it's interesting because I'm present to a communication I've been having back and forth with somebody that we've been working with, and they've also been having conversations with other people who don't necessarily deal with this day in and day out. So they're like missing components in terms of the understanding. So they went with somebody and formed, uh, for they have a real estate company to begin with, and the real estate nature of it's like passive in real estate. It's not like they're buying and selling property. It's not like they're a real estate agent. I'm sorry, a real estate broker, which is a different story altogether if you decide to do that way. But the business that this person particularly has deals with rental real estate. And small operations so far, they haven't grown to have like several properties. Really, that they're just dealing with one main rental right now. And this is something I want to bring to the surface, because you will get yourself into so much like confusion. Like you'll have so much confusion and headaches and unnecessary chaos when we don't put our entity structure together in a way that serves us. And if ignorance is not going to be an excuse for this, okay, it's not, because it's still going to cause you the pain and the suffering, even though you're in a situation where you feel as though you don't really know, you didn't have the background, you didn't have the understanding. And this particular person, they're off and on work with me, but then they have another relationship where they're going under the guidance of what they're telling her to do, when it comes to a real estate business. And man, don't do this, okay? Don't add extra layers of complexity. Like just because other people are telling you to add other layers of complexity to your business without really understanding what it's going to deliver. Please don't do that. I want you to keep things simple inside of what you're doing so that there is clarity, like there's intentionality. That this purpose is going to deliver exactly for what you intended to deliver. When you start adding layers of complexity, there are deviations from the intention. Okay, so what that means is that the purpose doesn't necessarily become as clear when there are deviations from that. And if you keep adding those layers, it's going to deviate even further and further, so that you won't necessarily know exactly what you're getting out of the whole situation. That you won't have the benefit that you were thinking about from the beginning. So I want you to definitely stick to the basics and stay clear with this, so that you can at least first and foremost have that initial outcome fulfilled, and then build upon that later on once you understand that you've achieved that certain foundational level, before you start adding layers of complexity. So this particular situation is a real estate rental company, only has one property, and now this person has, she started out pretty good soundly with just an LLC to get started, because that's all that she really needed for the real estate and the protection of it. And as long as she's operating the LLC properly, and it's like she's only member of the LLC. And later on, she was guided to convert it to a corporation. Okay. And in the way that doesn't necessarily serve. Okay. So there was, you'll look on the internet and you'll see like, okay, let's go out here and get a Wyoming company, right? Because if there's another layer of protection that's available if I own a company in Wyoming. There's another layer of anonymity that I can get, or go into Nevada or someplace like that and open up your company. Oh man, it's pretty cool. We can go out here and we can have so much protection now. Nobody can come after. Nobody can sue us now because we got Wyoming. Look at that. I'm legit. I have Wyoming. Look at me. Right? And all that comes down the line with our thought process, and we think we're doing something great, but we're adding this layer of complexity. Number one, for this particular person, they were advised to go into in a corporation. Didn't make much sense to do that. Okay. Why? Because the corporation doesn't really add any extra layer of protection than the LLC, because the LLC is designed for the protection. So it wasn't really necessary to have a corporation to have the protection there that the LLC already provided. And number two, they opened up the Wyoming LLC or and not the LLC, but the corporation, Wyoming Corporation, Inc. Okay, and they don't do business out there, right? They don't have any foothold. They don't have any nexus. They live on the East Coast. So it's like, well, the business is on the East Coast. So it's like, well, why? Right? They're not going to really get any protection established because the protection would really get them established in Wyoming if they were in Wyoming. Okay, do business in Wyoming, even if they have the Wyoming company. If they're doing business in another state, they would need to register in that state in which they're doing business to be afforded the type of protection that they're seeking. Okay, so it's like serving no purpose to open that up. But then there's extra costs because there are filing fees for that in that other state year after year after year. There's fees to maintain that, and it's just adding layers of administrative actions and unnecessarily. And then there is the aspect of this company was intended to be an S corporation, and then they forgot to actually register that with the IRS. So there's no real tax identification with that. They didn't do it necessarily in that way. They didn't fill the forms out to treat it as an S corp, and it would need to have some new EIN number with the IRS because now they've changed the name to Inc. rather than being the LLC. So they just opened up a whole new thing. They could have just kept it LLC and just kept the same EIN and the same. It's like a whole lot of other stuff that's going on because of the layers of complexity that were added. All right. And at the end of the day, it's not really the structure that's designed to benefit them beyond what the other initial structure was. Right. So we're dealing with real estate. They're like, now she's going to have to file an additional return, which is another cost if she's going to switch to an S corp. And does it actually warrant the extra cost if that one property is not generating enough income, to support the extra filing fees for an additional return, extra filing fee for multiple states, and down the line. So I want you to hear this, okay? And this is what I really want you to be left with in terms of it. You can even feel the stress coming up inside of your being, if you're present, by having all these extra layers of things that are not really necessary to begin with. And if we were just to keep it simple and align the structure in the way that is wanted and needed for that type of business model, well, then there's simplicity. There is a lot more peace. There's a lot more ease. There's a lot more clarity in what they're up to. And, there would be a lot like more straightforward communication about what to do and what not to do when it comes to filing things. So, this person is asking me to send them a K-1 when, first of all, that entity was not created for that structure until this year. Okay, which was recently. So there was no K-1 for the prior year, right? So K-1s, by the way, are just that part of the extra tax return. If you were to file a corporation, S corp specifically, or even a partnership, the K-1 is the part of that document that you would take that represents the pro owner share of that income of that entity. Okay, so basically the K-1 reports to your regular income tax, the proportion of that income that belongs to that owner. Okay, and it doesn't exist because that structure didn't exist for that person last year. All right, it wasn't reported that way until this year. All right, so there's confusion is what I want to say, and there's stress around the confusion, and you can see how that can keep spiraling if we don't get that under wraps, if we don't keep it simple. And the way that I want to deliver here in terms of the approach is to really build the block that we can stand upon before we start, building all the other components of the structure. Because, if we start building all the other components of the structure, the whole thing won't stand because we don't have the foundation block built. All right, that's what I really want you to be left with this. And that foundation comes with having a clear understanding of what it is that you're doing and what structure lines up with what you're doing, so you don't run into those headaches down the line. Like even she's experiencing confusion immediately because of this, but like even down the line, you will run into some issues because I've come into situations where we've had to restructure whole companies, like break everything down and restructure whole companies because of this. The foundation wasn't put into place from the start. Okay. And you don't want to do that. You want to make sure that the foundation is strong so you can have like clear traction of like forever from the beginning. Okay. And you can just keep building and building and building without having anything holding you up in the future. Okay. And it's going to come from having these foundational understandings of what to do. Hopefully that makes sense. I don't want to get too much further into that, but I just want to leave you with the like understanding that, there are extra things like complexities that you'll bring into a situation because you don't have that, the thinking process of just building that one block first and sticking with that until the outcome is fulfilled upon, and then building from there. All right. Super important, I feel, to really have that understanding so that you can set yourself up to win long term. Okay. Otherwise, you're going to experience the same type of headaches that I've heard from these conversations I've been in recently from people that have just been steered in a direction that didn't serve them. Okay. So let's keep this moving, guys. Now, partnerships. Okay. Getting back to partnerships and what we're here for in this conversation, partnerships really exist when two or more are gathered. Two or more are gathered, then you have a partnership. This could be two individuals. This could be two companies. It could be a combination thereof. Come together and say, this is how we're going to operate together. And for tax purposes, there's unlimited exposure to self-employment taxes with this structure. So it's like, I want to just mention that too, right here and right now. And then I'm going to come back to it before we wrap up with this call. But this partnership is expected to file a 1065 each year by the 15th business day of the third month after the closing of the year. So typically partnership returns are due on March 15th of the following year. Okay. So unlike individual tax returns that are due on April 15th, partnership returns are due on March 15th. And it's an informational return because the partnership in and of itself does not pay taxes. The taxes are passed through to the owners of that partnership. So the partners, the owners, the partners of that partnership, whoever has ownership over that partnership, the income gets passed through to them to handle on an individual level through that K1 that I talked about earlier. Each one of those partners gets a K1 depending on their proportionate ownership of that partnership. So if you have a 50-50 split, then 50% of that income of that partnership will go to each of those owners to handle at the personal level for their income taxes through that K1 form. All right, hopefully that makes sense. Definitely rewatch the video and hear this again if that's confusing for you. And I understand that a lot of people find that to be somewhat confusing, and it doesn't have to be. Simply, this is an informational return that partnerships file so that they can reconcile, they being, the committee of they being the IRS and, state tax agencies. And, so they can see exactly who to tax and for what amounts they need to be taxed in terms of the ownership of that partnership. Okay. So there are so many cool things that can be built off of this, but the important thing is to understand the foundational building block of what a partnership is and how it gets treated tax-wise. It's a flow-through entity. It's flow-through, meaning that the income of that partnership belongs to the owners. And the partnership does not have that income for tax purposes in and of itself. Okay. So pretty cool concept to think about. Now, there's some other aspects of the partnership return and the partnership that we want to really clear up. So we can have these types of partnerships. Like a general partnership is typically the way that it gets set up from the beginning is a general partnership, which means that there are equal owners of that partnership, and when they're like equal liability sharing with that partnership, and that's a general partnership. Okay, and there are also limited partnerships. Now the difference in terms of taxes means that, well, I said before that there's unlimited exposure to self-employment taxes when it comes to partnerships. So if it's a general partnership, similar to what we call a sole proprietorship, which we'll talk about later on another date, that income is considered earned income for the owners of that partnership. And when we're dealing with earned income, we're dealing with something called self-employment taxes. Okay, on a general partnership level, we're going to actually deal with self-employment taxes, which is an additional 15.3% tax on those who actually are earning income in that business, who are owners of that business as well. All right. So if you have ever been in a W-2 world, if you have remember being in a W-2 world where you just receive a paycheck from a company, you have this silent partner called FICA, right? And you see that, well, Social Security and Medicare comes out of that for that silent partnership from FICA. And typically you'll see it in the amount of about half of the total that's due. The employer pays the other half of what's due there. Okay. But when you are the employer and the employee, there is no half split. You have both sides of that obligation. And totally, that would be 15.3% of that obligation, which is the additional tax on earned income in the country that we live in. So when we think about partnership returns, there is no way to really limit that from a general partnership perspective. And if you have a limited partnership, then that changes the game somewhat, because now that's no longer earned income in a limited partnership, because you have a silent partner who's not actively generating revenue. They're not performing services. They're not earning the income. This is something that they're looking to gain passively. And if that's the case, well, then they don't have to deal with self-employment tax in addition to the ordinary income tax. It's just that ordinary income tax. Okay. And hopefully that makes sense, guys. Once again, rewatch this video and hear this out again if you have any confusion about that. All right. But it's pretty cool to think about, well, how to structure yourself in a partnership so you're going into the arena with your eyes wide open when it comes to taxes. Okay. So I talked about this a little bit before. Multi-member LLCs are treated like partnerships by default. So if you go in and start an LLC, you have multiple people in an LLC, it's a multi-member. Well, then by default, tax-wise, it's going to be treated as a partnership and expected to file this 1065 return. Okay. And the same thing applies when it comes to earned income and self-employment tax. So you want to understand, well, do I have a silent partner here that's a limited partner in this arrangement? Are they actively involved in this partnership? Am I actively involved in this partnership? How is this really being treated? If I'm going out here and providing services for it, well, then I'm responsible for self-employment tax when it comes to this, which is that additional 15.3% on earnings of the business, which is the net profits of that business. So there's some considerations to take into account there. And the thing that we have to understand is that, this separate return there are some administrative costs to having a separate return. Some people charge between, like, I've seen it, it's between $600 and $2,000 that companies will charge to file partnership returns. Now, if you have extensive activity going on in that partnership, it could be costly to file that return. Okay. When I say extensive activity, you have like a lot of assets, trucking company. Oh, you got a lot of assets, man. Which means there's a lot of things that are depreciating that needs to be accounted for. There are other schedules that want to be considered with that. Okay. If you have different types of income through that partnership, it's like, oh, okay, there's a little bit more of a layer of complexity there. It's going to cost you to file that return, man. All right. So those are some considerations there when, taking on the entity structure of a partnership when it comes to taxes. Okay. So there are administrative fees that you want to consider. Okay. So what are they? Do you know what they are? Have you taken that into account? Have you counted the costs of moving forward with the partnership? So that's there. Okay. And the other thing that we have here is like the clarity of like who are the people who are in this partnership arrangement. Even if you're a multi-member LLC, you just have multiple members. Well, what's the percentage of ownership here that we can have clear? How many people do we have in this partnership? How many beings do we have in this partnership that are making up a percentage of ownership here, and what percentage goes to one owner? That information will be reported on your K1 for that partnership, and then distributed to each one of those partners for them to file with their respective tax returns on the individual level, or whatever that looks like. Okay, and And just again, I just want to reiterate, it's a flow through treatment with that. So what that means is that that income does not necessarily get accounted for tax wise on the partnership level. It gets accounted for at the individual level through that K1 that gets distributed to them. All right, just to re-emphasize that point. Okay. All right, so just think about it like that. This is an informational return that gets filed for your partnership. This is all tax wise, guys. So just think about it from a tax perspective. The tax authorities are looking for this return to understand, okay, this is a total income that was made by the partnership. Yeah, but who does this belong to? This income. Who does this income belong to? Who's going to be taxed on this income? Oh, let me see the K1. Okay, based on everything. And it wants to reconcile at the end of the day. Just like you would file a W-2 with your tax return, it wants to reconcile what was filed with your employer, right? Because the employer will send that W-2 out and it says a certain amount that was given in wages and what was deducted in taxes. So what the employee files on their end wants to reconcile, which means it wants to look the same as what that employer filed. Now, this helps a lot with IRS because it'll detect any variances in that, and that's when the red flags come up. This is when it triggers audits and everything else. So it's important that everything matches up with this K1 for the partnership and versus what shows up with the K1 from each partner, the names and everything, and then Social Security numbers or tax ID numbers. All of that wants to match up, so that the checks and balances are there, and it doesn't raise any red flags. Okay, super important to understand. And how to pay yourself, how to take money from this, and understanding the nature of it. Now, said something about wages. Do you take wages in a partnership? Not really. You don't really want to take wages. There's something called guaranteed payments. Now we could talk about guaranteed payments. I don't want to get into that full conversation right now, but the thing that I want you to really get out of this is that you're not an employee of a partnership if you're the owner of a partnership. You're not an employee of a partnership if you're the owner of a partnership. So basically what that means is that they don't want to see any type of paycheck for you if this is a partnership structure and you're an owner of that. It would be like an out of alignment there. It doesn't make sense. So how do you pay yourself if you're not going to pay yourself a paycheck? So I've seen this where people do it, and there are ways for tax professionals to kind of walk that back so that there's in alignment with that per se. But it's something that you don't necessarily want to do because it could potentially raise red flags for you. The thing that you really want to get is that the income of that partnership, it belongs to the owners of that partnership. And because it belongs to the owners of that partnership, there are draws that you can take out of it. And they're not taxable. The draws, for the most part, they're not taxable. But if your company is profitable, which means it's making money and there's money in it to take out of it, well, then, yeah, you can just take money out of it in the form of a draw. And enough said. All right. And then that'll be how to pay yourself through your partnership. Enough said about that. Now, there are consequences to that all the way around. Like if we think about it, there's always an impact, is what I want to say. Not necessarily consequences, but there's always an impact to how you're taking money from that. Like, well, if you take money from that partnership, for example, then there's less money in that partnership to reinvest in that partnership and help that partnership grow. Okay. And so we want to understand the nature of that impact and how much do you want to leave in versus how much do you want to take out of that in order to make sure that your business is healthy and growing in the way that you want it to grow versus how much you need to take out of it to support your own individual and personal financial needs as partners of that partnership. Those are considerations. Okay. So the main way to extract income from this partnership would be to take a draw. And there are guaranteed payments. Okay. But once we get the guaranteed payments, whether the company is profitable or not, those guaranteed payments go into effect. That's what wants to be so. It needs to be counted upon that those guaranteed payments will be guaranteed. That's why they call them guaranteed payments. Now they really go to the owners of that partnership for services rendered inside of that partnership as a guaranteed payment. Okay. So that's pretty. That's something that we want to actually know and take into consideration as well. Okay. And last but not least, self-employment tax is something that we talked about and the impacts of that. So guys, we've talked about taxes when it comes to partnerships today. And, I'm actually wrapping up this conversation for you tonight. There's a lot that we did cover. And I want you to just really be with the simplicity of what it can be. And it just doesn't have to be complicated when running your business. I would like to see it so that you have a clear, eyes wide open look at how you're going into your business. Now, if you've already started your business and you've created an LLC, it's like, oh yeah, we have multiple members in the LLC, but I've been following the Schedule C. I haven't really filed the 1065. Like, well, it's like, well, why? You want to know that the technical way to approach this is to file that 1065 if you have multiple members on that LLC, and you know that you're out of compliance, which means that you're at risk. Okay, you don't ever want to be at risk in your business. You want to have the soundness of a peace of mind, so that you know that you're moving toward a direction of constant growth, where you can have the freedom and the wealth and the legacy for all of the efforts that you put in. We talk a lot about cash flow and everything that we can produce here, cash flow wise and profitability wise. But if you're doing things that are put yourself at a compliance risk, it's all for naught. You're not going to have access like soundly, like peace of mind wise, to the profits in that business if you're operating in a way that puts you at risk with the authorities that govern how these entities work. Okay, so hopefully this conversation was of value to you. If it was of value to you, you can definitely put the thumbs up inside of the chat. Leave me a comment below. If there's anything else that you want to discuss regarding this, if you have questions about this, you can do that either now or later on as you're watching this replay on social media or on YouTube. All right, but it's always a pleasure being with you in this conversation. I'm getting back to some of the basics in terms of what we're talking about here. You can hear it inside of the conversation tonight. I want people that really have the basics when it comes to these entities and structures and what they're used for and how they're broken up into tax treatment and then compliance and asset protection, so that you are going in here with a sure win inside of what you're up to. Yes, we went over C Corps, man. We went over that 2 weeks ago. Late to the conversation. You just check that video out on YouTube. All right, just go back on our YouTube channel, Your Accounting Superhero, and get all that you need there. We're going to continue this conversation next week. I want to talk about some more of the asset protection aspects of this. I want to get into like the that part of it for a little bit so that we can be shored up next week. But guys, it's been great being with you today. All right, and I'll talk to you next week. Have a good one until then. See you later. Bye-bye.